Pete Carway, who's the investment director of Praetura, which are a venture capitalist business. Pete's here to give advice and help people in terms of raising funds and what that journey looks like, and the tricks, tips, and advice that Pete's willing to provide us with today. Welcome, Pete.
Thank you very much, Gary. Appreciate it. Great pronunciation on the company name, as we've just been chuckling at a minute ago.
Stumbled across it easily. So yeah, the idea of today is just to help some people get the knowledge behind how, when they're trying to either start a business or grow a business, that whole sort of funding piece, and what happens where, and the pitfalls, and how we can time it, and give people a few tips and tricks along the way. So probably the best first question to start with would be just explaining the life cycle of the journey of finance, and when angels come in, when VCs come in, and when PEs come in, just to give us your view about that, really, to give us a flavour of timing and investment, and what's where and when and why, I suppose.
Yeah, sure. So I think usually the first stage is as people approach the position of raising investment, and that's all we're talking about, not so much debt today, but the investment angle on this. Usually the first stage is around angels. So angel investors that most people will have heard of, if not come across and met. They're usually single people or a small group, small syndicate of people who will invest very early. I mean, if you're giving the round a name, it's usually called the pre-seed round. But what that typically means is early stage, potentially pre-revenue business, or maybe less than 100k, just in the early stages. Typically amounts of cash that people raise, very common to raise up to about 150k. 150k was the SEIS amount. That's a specific tax scheme that a lot of angels use. That's a really common amount, but anything from kind of 25k to maybe $250,000 sits well within the angel group's range. In terms of due diligence that you would expect from an angel group, be fairly light. Most angels, I mean, they're investing their own cash, and quite often they invest it in something they've got an interest in. So they may already know a little bit about you, your sector, potentially your business as well. Quite often you know these people anyway. So due diligence is usually just getting to know you and a little bit of financial info, but it'd be quite light. The timing can be weeks. Very simple legal process. Quite often the standard documents on Companies House will suffice for something like that. So nice and simple. Then as you move up in terms of level of investment, you typically hit your smaller VCs. A smaller VC will be anything from kind of 250k to, let's say, 3 million, which is kind of where we sit, and the bulk of the VC community sits. So there's a lot of VCs that are around in that space. In terms of kind of the due diligence that they would do, it goes up a level. Definitely goes up a level from the angels, and the information that they would want about your business goes up a level. So you need to be thinking about the investor memo. All the information that you would pull together needs to be a lot more detailed when you start to speak to VCs proper. A lot of VCs like us will do all our due diligence internally, but you'll be looking at some financial due diligence. They may well be speaking to customers. There'll be some tech due diligence if you're a tech business, or if you're a supply chain business, a manufacturer, they will have a look at that and understand all the individual component parts. Fairly typical, 3 to 4 months, maybe something in that kind of range from you going out looking for VCs to getting cash. Everybody says at this stage expect something around the 6-month mark if you're ever going out, but usually it's a little bit shorter at this kind of end. And when a business that's looking for early stage VC would typically have a little bit of revenue. There's not so much investment at this size in the pre-rev businesses. A common number is $1 million ARR, right? But VCs like us, we don't have those kind of limits, but that's something that a lot of people talk about. But we've done deals anything from 100k, into the millions of annual recurring revenue. So you don't necessarily need a huge amount of revenue. You might have to be selective over which VCs that you approach, though. So just bear that in mind. After that, you've got you're into your larger VCs or your private equity companies. They'll be picking up businesses that are looking to raise 4 million plus, and there is no real upper limits. There's big checks and big financing out there for the right companies. You would typically have to have a couple of million of annual recurring revenue, lots of trackable kind of stats. The due diligence that goes up is mostly external. It's mostly paid. So you'll be picking up fees for some of the external DD that's done. Very common for those kind of processes to last 6 months or so. So but that's you've got to go all the way through for that.
So what's the difference between a VC and a PE then, a venture capitalist and a private equity scenario? What's the difference between the two?
VCs usually minority stakes. You take in, maybe 20% of a company ish. PE, it's private equity, so you take in control of a business, so you'd be buying 60-70% of a company. So
right. So the stakes are a lot greater.
Yeah. Therefore, the due diligence is a lot deeper, and the companies are a lot more mature. So you don't get PE coming into businesses that have got a couple of $100,000 of revenue and they're looking for $1 million of ARR or anything like that. This is later stage stuff we're talking about.
And the relationship between the angel and the VC is that quite common? So do many angels prefer which VC they want to then feed the next stage to, and they make introductions and are influential over that, or should the owner of the business be completely independent of that thought process?
It can depend. Angels do flip deals onto VCs that they know and trust. That just naturally makes sense, and we pick up a lot of deals from angel investors that know us and know how we invest and the types of deals that we look to do, and they've worked with us in the past and they like us, so they will send that on. So if you've taken on angels, ask them what their opinions are. They'll be pretty honest with you about the good and the bad. If they've had a negative experience with a VC, they're naturally going to say avoid them.
Right.
It totally makes sense. But there'd be nothing wrong with a founder taking on angel money and then saying, right, this is the direction I want to go. And some angels are more active than others, right? So some of them just write a check and you don't really see them again because they're spraying the money around and taking chances. Some are quite hands-on, some work very closely with the founders. And it really depends on what type of angel you've got in the first place.
Yeah. Okay, great stuff. And I suppose the big question that everyone kind of doesn't really know how to sort of think this one through in terms of the big one is valuation. How do you position what you're prepared to give away? How do you try and position what value you think your business is worth? I suppose there's not a straightforward, easy answer to that, but could you give us some idea of what your thoughts are on that? I suppose.
Yeah, no, you're absolutely right. There is no easy answer to something like that because there's so many variables. So we'll talk about it backwards. I mean, if you're a business that has got a couple of years of trading history, has got revenue growth, has got maybe some financial KPIs that are growing over a period of time, and you're looking at raising money at our kind of level, a couple of million quid or whatever it is, there's maybe formulas that you can apply to the data that will give you a bit more of an indicative value. We then as VCs have access to different sources of information, PitchBook and Bowhurst, and they give you industry stats for types of businesses and the multiples that you would apply to revenue or EBITDA or whatever it is. So we can use a whole host of different bits of information. We also have an entire pipeline and a portfolio of companies that we can look at. So we can profile a company against previous investments, and we can build our own. Value from there. If you come down in size of company and you start talking about especially angels and early VCs, businesses don't have that history. You know, you can't really apply a formula to a pre-rev business, right? Because there's no numbers to stick in there, so it doesn't really work. I suppose a bit of a cop-out answer would be that the market tells you the valuation. So companies at that stage are worth whatever somebody is willing to invest at. And there is some truth to that. I think if you're a founder that's looking to raise money, a broad rule of thumb would be in the early stages at each round of investment to expect to take 20-25% dilution in a round. And I think what I always say to founders in the really early days is you're best off sitting down with somebody that can help you with a little bit of financial modeling. And what you do is plan to get to a stage that will materially move the value of your business. Now, whatever that is, whether it's going live, getting a few customers on, whether it's reaching 100 grand revenue, whether it's, you know, whatever it is, plan to hit a stage. Get somebody to help you model back how long that will take and how much that will cost, how much development work is in there, how much marketing spend needs to be, all those kind of things. Now, that's really what you want to be raising for. It's to raise to a point. I think where we see people giving too much of the company away is often, I'm going to raise 150 grand because sounds like a lot of money right now, right? You know, because that is something that does happen, believe it or not, more often than you think. And I think that's where people over dilute themselves in the early stage. I think if you can have some more plans and structure, nothing ever really goes to plan. So I would always add on, you know, a margin of error, but have in mind where you're trying to get to and how much you believe that should cost. And that's what you go out to raise. Expect 20-25% dilution each time you raise money in the early days. So that's the kind of the rule of thumb. I would typically, if I was an early stage founder, I would avoid putting in investment decks that I'm trying to raise a certain amount and I'm willing to give away X%. No, it doesn't particularly mean anything to sophisticated investors anyway, because we will build our own value. It's good to know where the founder's head's at, but it's not necessarily going to determine where we land on value. And it has the potential to put early stage investors, angels in particular, put them off making an offer in the first place. It probably on average does more harm than good to do something like that. So I just wouldn't do it.
Yeah, no, that's really, really good advice. And there's some really good pointers in there that's going to be very, very helpful. So moving on, if you were to approach a VC, then one of the first things is the pitch, isn't it? The pitch deck. And again, it's just like valuation. You know, everybody has a different opinion about what that should look like. Could you give us, again, it's your personal view, but you sit in that seat every day and you see these. So give us some advice about how you think people should sort of put that together.
Yeah, sure. So we like to give you a bit of context. Criteria, we see between 100 and 200 a month. It's quite seasonal, our business, so there's kind of peaks and troughs. But at most we'll be in the kind of 200 range. So we see a lot. Now, any business where you're reviewing information, if you're getting a couple of hundred in each month, you've got a small team, you've got active deals that you're doing, you speak to investors, all these other bits and bobs. There's only a limited amount of time that you're going to give to pitch decks. I think it's really, really important that people remember the purpose of a deck. You know, especially if you're cold emailing, dropping an investor memo into an inbox, which is how you generally contact us. Probably 90% of our pipeline is just people pinging the inbox. Now, what you want to avoid is trying to answer every question that an investor could potentially ask and produce in a 40 or 50 page pitch deck. Now, we do get quite a lot of them. VCs generally will skim read. You know, that they spend a minute or two per deck. The point of the investment deck is just to prick the interest of somebody so that you can bring them to the table. so that you get the call that says, come in and meet us, let's have a chat, or let's get on Teams or whatever. Like, and that's where you start to really sell the business, you sell yourself, and that's, you start to develop the relationship from there. So what I've always said is you'll never win an investment off an investment memo or a pitch deck, but you can definitely lose it. You can definitely lose it, because if we read through and we just can't find the information that we're looking for, because we are skim reading, and we are all guilty of that, the chance of getting that call diminishes massively. So I would always say probably 10 pages, really clearly explain what the business does. It's amazing how many decks you read and you just think, oh, I don't actually understand what the business is doing. Like, it's the problem and the solution, you know, and yeah, the amount that we read that we don't fully understand is incredible, and that really reduces the chance. We might fire some questions back, but you're probably not going to sit and speak to founders if you don't fully understand what they do. Differentiation is often missed. So once you've done your explanation of what the company is, the problem it's attacking, how it attacks it, so the problem solution, and then a bit of differentiation around why we're better than the competition, or why we're different, what's protectable, all that. A bit about the founder themselves in the early stage. You know, it's all about the people that run the business, and that's a major part of the investment. So a little bit of detail around them. Probably then touch on market, and it's more about like your accessible market, who you can address on day one, because most decks that we see have a $30 billion market, and it's, you know, small company in a WeWork, wherever you are, your addressable market is not really 30 billion. So what can you address over the next, you know, year or two, which is when you're going to use this investment, and then what's the big picture? No problem with the big total market, but make sure you explain that first bit, and then if you're going to put anything in about, you know, don't forget the actual ask. A lot of debts miss the amount that you're looking to raise. Dead easy to miss that. Dead easy not to think about it. But, you know, we need to know, because we only invest between 1 and 2 million. So if you're not in that kind of range, we do go a little bit outside that. But if you're not in that range, then you're not going to be suitable for us. If you don't tell us, it's again, chances of the call goes down. And then if you're going to put any financials in, keep them fairly high level. You don't need to go into massive amounts of detail. A few key stats, little bit around growth and some high level numbers, but that's it. You should be able to get all that kind of stuff in 10 pages ish, something like that. I think that's the best way to maximize your chance of getting the call, getting the meeting in the first place.
Right, good. So basically, straight in with the industry that you're in, what product or service you're providing to who, why there's a gap in the market, what makes you different to reach that gap, how big that opportunity looks, a bit about the company, the people, and then high level financials in terms of where you want to get to, what milestones, and obviously what money you're after to get there.
Yeah, and that's a lovely structure. It's that's a lovely doc, and just always remember the purpose of that initial doc, just to get the phone call in the first place. It's not to answer every question that we would have like that. That's best done in a conversation. So
yeah, good, great advice. And I think a lot of people probably don't know where, you know, some entrepreneurs will be detail people, so they want to give you all the detail. Some entrepreneurs the big picture and they don't give you enough details. So it's good to get this advice to know where that happy medium is. That's really helpful. So in terms of if we get the advice from you and we sit down and somebody's successful and you become a partner of theirs, then there's usually some contractual terms and conditions and stuff that are agreed between the two parties. Do you want to give us a bit of, you know, again, there's probably myths around that, isn't there, Pete, about, you know, people hear these stories. Give us your side of your view about sort of what's realistic to expect and the background on that.
Yeah, no problem. I mean, this changes massively depending on who you're trying to raise your money off. So if you're looking at angels and you're doing small checks, typically there's not much conditionality that comes along with that. They're usually done off fairly standard. company's house documents.
Yep.
When you come to us and you start to raise somewhere between one and three, then we will use VC approved legal documents, and they will include terms that potentially founders, especially if it's your first time, have never come across before. But what you would usually expect to see if you're raising 1 to 2 million, somewhere in that kind of range, is the investor will want a board seat, so often called an investment director. So that's somebody who will work with the founder of the business and senior management team on. It varies tremendously between VCs as to how active those people are. Some just turn up to boards on a monthly basis and speak to people. Some, like us, spend time in between boards on, weekly, daily, whatever it is that the founder wants. So we just actively encourage people to give us a call, and we use our whole network. But there will be some form of board seat. There is usually something called investor consents. Now, these are things that the business will no longer be able to do without approval from the investors that are going in. Initially, it might sound a little bit unfair, but it's typically restricted to things like changing salaries of the founders. So if we put £1 million in, you can't pay yourself £500,000 bonus. So it starts to make sense once you see the list, and it will be not hiring above a certain salary threshold, not hiring if it's not in the financial plan that's been agreed, not changing the course of the business. So not, we invest in a SaaS B2B software, not saying, right, we're going to put all our money in direct to consumer app. It's not changing things like that. Not changing the legal documents of the business, not taking on more money from other investors without at least a consultation process. So they start to make sense once you see the list, but initially it's like, giving control away, and it can be different. Another really big one, which is quite common, and it in the first case can take people by surprise, is the concept of good and bad leaver and shares vesting over a period of time. What that means is when an investor puts money into a business, the founder has to stay for a period of time to hold on to the equity. So what it's designed to do is to stop VCs putting a significant amount of money into a business and a founder leaving, just resigning and walking off the next day.
Yeah.
So again, when you first hear it and you first see it, you think, that's a real shock. Technically, I won't own all of the shares in my own business. It doesn't feel fair. When you talk through the logic of the reasons why, it all starts to make sense. And there are reasons that people leave a company that are deemed as bad leaver, and there may be a punishment that you lose some of your shares. There are reasons why you'd be a good leaver and you keep shares. So all of those individual conversations are completely unique to the deal. But in general, vesting, good and bad leaver are pretty common when you hit our level. The vast majority of deals that you do above £1 million of investment will contain that in some way, shape or form.
Because those major people have got the information, haven't they? They're the key people with all the knowledge. If they were to go, then the value completely changes, doesn't it?
Yeah, it could end the business, could materially bring down the value. I mean, it's highly likely to have a major impact if the founders of the business were to leave shortly after investment. Potentially the company just collapses around them. So it's just a protection around putting significant amounts of cash in and that scenario happening. And at the end of the day, if founders stay in situ, you don't have to worry about any of that. Because it's irrelevant.
Yeah, exactly. Yeah, and to dovetail into that one, then the final question is fees and hidden costs. Sort of how do what does it cost to sort of engage with a VC, and where are those charges, and what can people expect?
Yeah. So again, it will change, but what you typically get is and again, I'm talking about VCs, not angels. So angels, that maybe no real cost, maybe a little bit of legal work in the beginning and unlikely to be too much in the way of ongoing costs. What you'd usually get from a VC is there'll be a completion fee, which is payable by the company, which will be a couple of % of the investment. One area that really surprises people the first time they do this is that any legal fees and any external fees that are provided to the deal is charged back to the deal, so the company ends up paying for it. That can come as a bit of a surprise, but it's industry standard. And if you think about it, outside of VC in the banking world, if you're ever doing a deal and there's a mortgage broker involved, it's the person that's receiving the cash that pays for it. It's the same thing in the VC space. And then depending on their model and who they put around the board and what support networks they've got, and there's usually an ongoing monthly fee that the company then pays to the VC. That can vary, but typically 2,000 or 3,000 a month is pretty common to be charged. Again, once you're raising 1 to 2 million, that's usually what you get. If you have multiple VCs on the cap table, so multiple people that are investing as part of a round, they may all charge an ongoing fee, and then it's down to the founders to try and negotiate and bring that down, maybe on average.
Right.
But yeah, it's very, very common. I don't know if I call them kind of hidden fees. Most VCs are pretty open and honest about it. I think it does surprise founders though, especially in the earlier stages, and I think it's fair. If you take a step back and you think about how VC works, in the EIS space where we invest typically for 5 to 7 years. So we may have 2 million quid that we've put into a business that in 5 to 7 years we're hoping that we'll get a couple of multiples on that, but we've got a whole team, we've got a whole company to fund, and that is a long cash flow cycle, which is why people charge fees. It's to support the business through those long periods, and at the end of it, because we're investing early, unfortunately, you can 7 years later you could lose your money. So you're not always guaranteed that you're going to get the return at the end of the day. But that's the reason why VCs charge money, is to fund the company in the interim.
Yeah, great stuff. Okay, so just in closing then, Pete, if people were interested in a VC how would they contact your company, and what would that process look like, just to wrap this up then?
So I think there's 2 ways. There's obviously personal networks that we're out and about on the roads. We come up to Fraser House quite a bit. We've met yourself and Rory and the guys, so you can get access to us via a warm intro from many people around the Northwest. Every VC will have a website, and there'll be a little portal on there that'll be for founders to fill in usually a 10-question bit of detail. Who are you? What's your business? How much are you looking to raise? Background, revenue level, all that kind of stuff. And then you attach your investment memo onto that, and it comes into a pipeline for an investment team to pick up and review and contact the founder.
Great stuff. Excellent. Well, thanks very much for your time today, Pete.
No worries. Hope that was useful. And if you get any kind of follow-up questions, Gary, I'm more than happy to pitch answers or go into more detail on any of it. No problem.
Brilliant.